I want you to understand why the question of paying off a mortgage early creates so much emotion. On the surface, it looks like math. You have a mortgage rate, you have a possible investment return, you compare one number to the other and choose the larger one. That sounds simple, but real financial decisions are rarely only about the number. They are about risk, timing, taxes, inflation, liquidity, retirement, behavior, control, and peace of mind. That is why two intelligent people can look at the same mortgage and make different choices. One person looks at a 3% mortgage and says, "This debt is cheap. I should invest." Another person looks at any mortgage at all and says, "I do not want to owe anyone money. I want the house paid off." Both may be acting rationally inside their own system. The mistake is believing that one universal answer fits every person. That is not how financial systems work. A mortgage is not simply a debt. It is a fixed obligation inside a larger life. And an investment account is not simply a return number. It is a volatile asset that may or may not deliver the expected return at the time you need it. So the real question is not only which number is higher, the real question is which choice makes the whole system more resilient for the life you actually have. That is the Dalio way to look at it. Not one variable. The machine, the simplest version of the equation is this. If you pay off your mortgage early, you receive a guaranteed return equal to the mortgage rate. If your mortgage is 6%, every extra dollar used to reduce the mortgage gives you something like a guaranteed 6% return because you avoid paying that interest. If your mortgage is 3%, paying it off gives you a guaranteed 3% return. That is simple. Investing is different. Investing may produce higher long-term returns, but they are not guaranteed historically. Stocks have produced strong returns over long periods. The broad stock market has often delivered roughly 7 to 10% over long horizons, depending on whether one looks at nominal or real returns. And the time period used, a conservative portfolio may produce less. A tax-efficient investor may keep more. A taxable investor may keep less, but none of it is guaranteed. The market return is a probability. The mortgage interest saved is certain. That is the central trade-off. Guaranteed return versus uncertain return. Control versus optionality. Debt reduction versus compounding. Safety versus growth. Once you see the decision that way, the argument becomes clearer. The first zone is the low-rate mortgage zone. If your mortgage rate is somewhere between 0 and 4%, the math usually favors keeping the mortgage and investing extra dollars instead. Why? Because the mortgage is cheap. If you borrowed at 2%, 3%, or even 4%, you borrowed at a rate that may be lower than what long-term diversified investments can reasonably be expected to earn. That spread matters. If your money can potentially earn 7% over decades while your debt costs 3%, paying off that debt early may reduce your long-term wealth. But there is another force working in your favor when the mortgage rate is low: inflation. A fixed-rate mortgage becomes easier to carry over time if inflation and income growth raise the nominal value of everything else while the payment stays fixed. Your mortgage payment does not rise just because groceries, wages, and rents rise. The payment is locked, so each year the dollars used to repay the mortgage may be worth a little less in real terms. If inflation averages 2 to 3% over time and your mortgage rate is 3%, the real cost of borrowing may be close to 0 or 1%. That is extraordinarily cheap money. In that situation, the mortgage is not only low cost, it may become less burdensome with time. The terms stay fixed. Your income may rise, prices rise. The payment becomes a smaller part of the whole system. This is why I would be cautious about rushing to eliminate a very low fixed-rate mortgage. A low fixed-rate mortgage can be an asset in disguise. It gives you capital to invest elsewhere. It gives you flexibility. It allows inflation to reduce the real burden of the debt. And if you are young enough, it lets compounding work on money that otherwise would be trapped in home equity. But that does not mean everyone with a low-rate mortgage must keep it forever. If the mortgage creates psychological stress, if fixed expenses are too high, if retirement is close, or if the person cannot invest consistently, then the decision changes. The low rate helps the math. It does not automatically solve the life. The second zone is the gray zone. This is roughly 4 to 6%. This is where the question becomes more complicated at 4%. The argument for investing may still be strong, especially for a young investor with decades to compound. At 6%, the argument for paying down the mortgage becomes stronger, especially for someone closer to retirement. In the middle, the answer depends heavily on taxes, risk, time horizon, and temperament. This is the area where people get stuck because the numbers are close. If your mortgage is 5.5% and your after-tax investment return might reasonably be 5 to 6%, the spread is not large. And when the spread is small, risk matters more. A 5.5% mortgage payoff is a guaranteed return. A 5.5 or 6% investment return is not guaranteed. The investment may earn more over time. It may also suffer losses early in the period when you need the money. So the question becomes, is the uncertain extra return worth the volatility and stress? For one person, yes. For another, no. That is why the gray zone is not solved by a simple formula. It is solved by understanding the whole financial life: liquidity, age, income stability, emergency fund, tax bracket, retirement timeline, investment behavior, risk tolerance, mortgage size, monthly payment, spouse, comfort, market exposure. All of these matter. The third zone is the high rate mortgage zone. Once a mortgage rate moves above roughly 6%, paying it down becomes much more attractive. A 6% or higher guaranteed return is hard to replicate after taxes, volatility, and sequence risk. This is especially true if the person is approaching retirement. A 6% guaranteed return is not the same as a 6% expected market return. The word guaranteed changes the nature of the decision. Markets can decline, portfolios can suffer, returns can arrive late, but mortgage interest avoided is not late. It is immediate and certain. Every dollar of principal reduced lowers future interest owed. There is no market crash that reverses that benefit. This is why higher mortgage rates change the decision from growth optimization to resilience optimization. You may not maximize upside by paying off the mortgage early, but you improve the durability of the plan. You reduce fixed expenses. You lower stress. You reduce the amount your portfolio must produce in retirement. You make your household less fragile. That matters. A resilient plan may not always be the plan with the highest theoretical return, but the highest theoretical return is useless if the person cannot endure the path. This is where the personal part enters. Some people can hold a mortgage and invest through volatility without panic. Others cannot. Some people feel strong with more liquidity and market exposure. Others feel strong only when the home is paid off. Financial planning must respect human nature because the person must live with the plan. Now let us go deeper than the interest rate. Comparing your mortgage rate to historical market returns is a starting point, but it is incomplete. There are three adjustments that matter: after-tax real returns, risk, time horizon. Start with after-tax real returns. People often say the stock market returns 7% after inflation, or roughly 10% nominal over long periods. But you do not always keep the full return. If you invest in a taxable account, capital gains taxes, dividend taxes, state taxes, and turnover can reduce what you keep. A 7% return before tax might become 5 or 6% after tax, depending on the investor. The more tax efficient the portfolio, the better. Index funds and ETFs tend to be more tax efficient because they often have lower turnover and more qualified dividends that can help. Instead of seeing a large tax drag, a careful investor might keep a return closer to 5.5 or 6.3% after tax, depending on the tax bracket, state dividends, and realization behavior. But account type matters. If the money is invested inside a Roth IRA, Roth 401k, traditional IRA, or another tax-advantaged account, the current tax drag may be very different. In a Roth account, qualified growth may be tax-free. In a traditional account, growth may be tax-deferred. In those cases, the comparison between investing and mortgage payoff changes. 7% may really behave more like 7% inside the account during the accumulation period. That makes investing more attractive. This is why the same mortgage rate can lead to different answers for different people. A person investing in a taxable account in a high tax state is not the same as a person investing inside a tax-advantaged account. Taxes change the spread, and when the spread narrows, risk matters more. Now, risk: paying off the mortgage is certain. Investing is uncertain. That uncertainty has value and cost. Historically, markets reward investors over time for accepting volatility, but the path can be painful. There can be down years. There can be several down years. There can be crashes. There can be long recoveries. There can be periods where the expected return does not arrive when you need it. This is where sequence of returns risk becomes very important. If you are far from retirement and still contributing, a market decline may be painful but potentially useful because you are buying more shares at lower prices. If you are in retirement or close to retirement, a severe market decline can be much more damaging because you may be withdrawing from the portfolio while it is down. Selling assets during a downturn reduces the base that can recover later. That is sequence risk. It is one of the most important retirement risks. A mortgage payment increases the amount you must withdraw from the portfolio. If markets fall early in retirement and you still need to make a large mortgage payment, your withdrawal pressure increases. That can damage the plan. So, near retirement, paying off the mortgage may reduce risk more than the raw interest rate comparison suggests. A 5% mortgage may not look urgent to a 35-year-old. It may be much more important to a 65-year-old drawing from a portfolio. That is why age and time horizon matter. If you are 20 or 30 years from retirement, investing tends to have a strong case. Over long periods, the stock market has historically had a high probability of positive returns. Time allows volatility to be absorbed. Compounding has more runway. The younger investor may be better served by keeping the mortgage, especially at lower rates, and investing aggressively in tax-advantaged accounts. But as retirement gets closer, the math changes. You no longer have the same recovery window. Your portfolio may need to support withdrawals. Fixed expenses become more dangerous. Lowering those expenses can reduce the required withdrawal rate, and lowering the required withdrawal rate can make the whole retirement plan more durable. That is why paying off the mortgage before retirement can be so powerful. It may not maximize the theoretical ending portfolio balance, but it may reduce the probability of failure. In a good plan, the goal is not only to get rich, the goal is to avoid being forced into bad decisions when conditions turn against you. Now let us look at the two basic paths. The first path is keeping the mortgage. This path prioritizes growth and optionality. It tends to make sense when the mortgage rate is low, usually around 2 to 4%, when the household has strong liquidity, when emergency reserves are solid, when the time horizon is long, when the person is not dependent on the portfolio for near-term income, and when the person can emotionally tolerate market volatility. In this path, the mortgage is relatively cheap capital. You keep the debt because the debt is manageable. You invest extra dollars because the expected long-term return is higher. You preserve liquidity. You avoid locking too much money inside the house. You allow compounding to work. This is a growth-optimized strategy. It does not mean the mortgage is good forever. It means that under these conditions, the extra dollar may do more work in investments than in the mortgage. The second path is paying off the mortgage. This path prioritizes stability and control. It tends to make sense when the mortgage rate is closer to 5, 6 or higher, when retirement is close, when the household is drawing from the portfolio, when fixed expenses feel tight, or when the monthly payment makes the plan fragile. In this path, the mortgage is not just a rate, it is a recurring obligation, a fixed monthly demand on your life. If you reduce or eliminate it, your required cash flow goes down. Your retirement withdrawals can fall, your stress can fall, your dependence on market returns can fall, your ability to survive downturns can improve. This is a resilience optimized strategy. It may not produce the maximum upside in a long bull market, but it can make the plan work across more environments. That is valuable. Now, there is a better question than, is my rate lower than market returns? The better question is, does this debt make my plan more fragile? A low-rate mortgage may still make a plan fragile if the payment is too large relative to income. A high-rate mortgage may be tolerable if income is strong, savings are high, and the investor has decades ahead. The rate matters, but the plan matters more. A mortgage payment is a fixed expense. In retirement, fixed expenses are extremely important. The higher your fixed expenses, the more income your portfolio must produce. The more income your portfolio must produce, the higher your withdrawal rate. The higher your withdrawal rate, the more vulnerable you are to poor market returns early in retirement. So reducing fixed expenses can be more powerful than simply chasing a higher return. It lowers the required withdrawal rate. A lower required withdrawal rate can protect the portfolio. That is why people near retirement often value a paid-off house so highly. They are not always trying to maximize the spreadsheet. They are trying to protect the life. There is a difference. Now, the decision does not have to be all or nothing. This is one of the most important practical points. You do not have to choose between paying off the mortgage aggressively and investing every extra dollar. You can use a hybrid strategy. You can split extra cash between investing and mortgage prepayment. This reduces regret. It allows compounding to continue. It also captures some guaranteed return from reducing the mortgage. It keeps the plan flexible. This is especially useful in the gray zone when the mortgage rate is 4 to 6%, and the answer is not obvious. Splitting the difference can be sensible. If the market performs well, your investments benefit. If the market performs poorly, your mortgage balance is still lower than it would have been. You are not maximally optimized, you are more balanced. Optimization often looks good in hindsight. Resilience is more useful before the future is known. Now let us use the example from the source document, a $400,000 mortgage, 30-year fixed. 6.5% interest rate. The monthly payment is about $2,500. Over 30 years, the total amount paid toward the mortgage is around $910,000. More than $500,000 of that is interest. Those numbers are serious. A 6.5% mortgage is not cheap debt. It is a meaningful fixed obligation. Now imagine a 35-year-old borrower at 35. Time is the most valuable asset. The person may have 25 or 30 years before retirement. They may be entering peak earning years. They have time to ride through market volatility. In this case, even at a 6.5% mortgage rate, going all in on mortgage payoff may not be optimal if it prevents investing for many years. Why? Because early investment dollars are extremely powerful. A dollar invested at age 35 and left to compound for 30 years at 7% can become more than $7. A dollar invested at age 45 under the same return but with only 20 years to compound may become less than $4. That difference matters. Time changes the value of the dollar. So for the 35-year-old, the optimal approach may be to lean toward investing while still paying some extra toward the mortgage. Maybe 80% of extra dollars go to investing and 20% go to the mortgage. That is only an example, not a universal rule. The principle is that the younger person should be careful not to sacrifice the most powerful compounding years by overfocusing on mortgage payoff. At the same time, the 6.5% mortgage is not irrelevant. Adding some extra principal payments can capture a guaranteed return and reduce future interest. This is why the hybrid approach can make sense. Now consider the 45-year-old at 45. The time horizon is shorter, retirement is closer. The portfolio may already be larger. Sequence risk is becoming more relevant. The person has maybe 15 or 20 years until retirement, not 30. Now the same 6.5% mortgage becomes more serious. The mortgage payment may still be there as retirement approaches. If it is not reduced, it can increase withdrawal pressure. So the 45-year-old may want a more balanced split, maybe 60% of extra dollars to investing and 40% to mortgage payoff, or perhaps 50-50 again. The exact split depends on the person. But the principle is that as retirement approaches, reducing fixed obligations becomes more valuable. The math shifts from maximizing growth to protecting the plan. The same mortgage can call for a different answer at different ages. That is why rigid rules fail. Now let us examine the $400,000 mortgage example more deeply. If no extra payments are made, the mortgage is paid off at age 65 for the 35-year-old borrower. Total interest is over $500,000. That is a very large cost. If the borrower adds $500 per month for the first 10 years only, the loan may be paid off roughly 6 to 7 years early. Total interest may fall to around $380,000 to $400,000. That saves over $100,000 in interest. That is real money. And because the extra payments happen early, they are especially powerful. Early principal payments reduce the balance. When the balance is largest, that means less interest accrues for decades. There is something very appealing about that. It is guaranteed, it is visible, it shortens the debt, it gives the household a clearer path to being mortgage-free. But now compare the opportunity cost. If the same $500 per month is invested for those first 10 years at a 7% return, then by age 45 it may grow to about $86,000. If that money is then left alone for another 20 years with no further contributions, by age 65 it may be worth about $330,000. So the mortgage prepayment saves perhaps around $120,000 in interest and pays off the loan 6 to 7 years early. The investing path may create around $330,000 in wealth, but the investing path is not guaranteed. The mortgage savings are guaranteed. That is the trade. This is why the decision is not obvious. If you only look backward at average market returns, investing appears better. If you only value certainty and debt freedom, mortgage payoff appears better. A complete decision must include both. The extra wealth from investing is variable. The interest saved from mortgage prepayment is certain. One path creates a larger potential asset. The other path eliminates a fixed liability. Assets and liabilities behave differently in a crisis. In a severe market downturn, the investment account may fall. The mortgage payment remains due. That is why a person with a fragile income or approaching retirement may value debt reduction more than the spreadsheet suggests. Now I want to explain why mortgage prepayment early in the loan is more powerful than late prepayment. At the beginning of a mortgage, the balance is high. Interest is calculated on that balance. A large portion of the payment goes to interest. When you make extra principal payments early, you reduce the balance on which future interest is charged. That benefit compounds through the loan late in the mortgage. Much more of the payment is already going to principal. Extra payments still help, but they do not have the same decades long interest saving effect. This is why adding $500 per month early can cut years off the mortgage and save large amounts of interest. But those same early years are also the most powerful years for investing. That is the central conflict. The same dollar is most powerful in both places early on. It is powerful against the mortgage because it reduces long-term interest. It is powerful in the market because it gets decades to compound. That is why the decision must be made carefully. Now, what about peace of mind? Data cannot fully quantify it. You can build a spreadsheet, you can model after-tax returns, you can model inflation, you can model mortgage amortization, you can model investment compounding, you can model risk, but peace of mind is not easy to put into a cell. For some people, a paid-off house is worth more than the financial spread. They sleep better, they feel safer, they feel in control, they feel that no matter what happens in the market, the roof over their head is not dependent on monthly debt payments. That feeling has value for other people. The peace of mind comes from liquidity and optionality. They do not want all extra money locked inside home equity. They want investments, cash reserves, tax-advantaged accounts, market exposure, flexibility. They feel safer knowing they have assets they can access or grow. That also has value. The key is not to mock either personality. The key is to understand your own. A plan that looks optimal on paper but makes you anxious may fail because you will not follow it. A plan that gives peace but starves long-term growth may create a different risk. The best plan is one you can execute through stress. That is why behavior matters. If you keep the mortgage and invest the difference, you must actually invest the difference. Many people say they will, then they spend it. That changes the whole decision. Keeping the mortgage only works as a growth strategy if the money that would have gone to the mortgage is invested. If it is consumed, you did not choose growth, you chose spending. This is one of the biggest hidden problems in the debate. People compare paying off the mortgage to investing. But in real life, the alternative may not be investing. It may be lifestyle inflation, vacations, cars, restaurants, subscriptions, home upgrades. If paying off the mortgage forces discipline and investing does not happen consistently, then mortgage payoff may win behaviorally, even if investing wins mathematically. This is why systems matter. If you choose investing, automate the investing. If you choose mortgage payoff, automate the extra principal payment. Do not rely on motivation. Motivation changes, systems continue. Now let us discuss liquidity. Paying down a mortgage increases home equity. That can be good. But home equity is not the same as cash if you lose your job. The bank will not accept the sentence. I have equity in my house as your monthly mortgage payment. You may need a home equity line of credit, refinancing, or sale to access that equity in a crisis. Those options may not be available or may be expensive. That is why paying off the mortgage too aggressively while keeping insufficient cash can make you fragile. Before making large extra mortgage payments, build an emergency fund. Maintain liquidity. Do not sacrifice all flexibility to reduce debt. A paid-down mortgage with no cash may feel safe until life demands cash. This is another reason hybrid strategies can work. Some money to investments, some to mortgage, some to cash. The exact split depends on the situation. But the principle is to avoid becoming house rich and cash poor. Now, taxes again. Mortgage interest may or may not be deductible depending on your situation. Many people take the standard deduction, which means the mortgage interest deduction may not provide a meaningful benefit. If you itemize and the deduction is meaningful, the after-tax cost of the mortgage may be lower than the stated rate. That can make keeping the mortgage more attractive. But do not overestimate this. A deduction is not a credit. It reduces taxable income. It does not give you all the interest back. You need to calculate the real benefit for your situation. On the investment side, taxes also matter. Taxable brokerage returns may face dividends and capital gains. Tax-advantaged accounts reduce or defer that drag. So before deciding, compare after-tax mortgage cost to after-tax investment return. Pre-tax numbers can mislead. The more precise you become, the better the decision. Now, let us talk about inflation. Inflation can favor fixed-rate borrowers. If your payment is fixed and your income rises with time, the payment becomes easier. This is especially true for low-rate mortgages. A 3% fixed mortgage during an inflationary period can be very attractive. The lender receives dollars that may be worth less over time. The borrower repays with cheaper future dollars. That is why paying off a low fixed-rate mortgage early may be giving up an advantage. But at higher mortgage rates, inflation may not fully rescue you. A 6.5% mortgage is still a large nominal obligation. If inflation falls back down, the real cost may remain high. If wages do not rise enough, the payment still pressures the household, so inflation is an important variable, but it does not override every other factor. Again, the whole system matters. Now, what about retirement planning? This is where the mortgage decision becomes especially important. In retirement, income is often more fixed. A person may rely on Social Security, pensions, portfolio withdrawals, or part-time work. A mortgage payment increases required income. If the mortgage payment is $2,500 per month, that is $30,000 per year. To fund an extra $30,000 of spending from a portfolio using a 4% withdrawal rate, one would need roughly $750,000 more in portfolio assets. That does not mean everyone must pay off the mortgage, but it shows how large a fixed expense can be. A retired person with no mortgage can live on much less income. Lower spending means lower withdrawal pressure. Lower withdrawal pressure means lower sequence risk. Lower sequence risk means a more durable plan. This is why paying off the mortgage before retirement can make emotional and financial sense, even if investing might have produced a higher expected return earlier in life. At retirement, certainty becomes more valuable. When you are accumulating, volatility can be your friend. When you are withdrawing, volatility can be your enemy. That change matters. Now, what if someone is young and has a high mortgage rate? This is more difficult. A 35-year-old with a 6.5% mortgage faces a real trade-off. The rate is high enough that paying it down is attractive, but the time horizon is long enough that investing remains very important. This is where I would avoid extremes. Do not stop investing completely if that means missing years of tax. Advantage compounding, maximize employer match if available. Use Roth or traditional retirement accounts where appropriate. Keep building long-term assets, but also consider extra mortgage payments because a 6.5% guaranteed return is meaningful. A split strategy may be best. For example, invest the majority of extra dollars while sending some extra principal to the mortgage. As income rises, you can adjust. If market valuations are high and the mortgage rate is high, perhaps more goes to the mortgage. If retirement accounts are underfunded and time horizon is long, perhaps more goes to investing. The point is to balance growth and resilience. Now, what if someone is 45 with the same mortgage? The balance shifts. The person is closer to retirement. They may have less time to recover from market downturns. They may already have a meaningful portfolio. The mortgage could still be present near retirement if not addressed. Here, more extra dollars may go toward mortgage payoff, not necessarily all, but more. The goal is to reduce fixed expenses before withdrawals begin. A large mortgage at retirement can make the plan fragile. Reducing it earlier can give the person more control. This is why age is not just a personal detail. It changes the financial physics. Now, what if someone is already retired? If retired and holding a mortgage at a high rate, paying it down may be very attractive if doing so does not destroy liquidity. But caution is needed. A retiree should not take all liquid assets and put them into the house if that leaves no emergency fund, no market exposure, and no ability to handle medical costs or repairs. Debt freedom is good. Liquidity is also good. You need both. Sometimes refinancing is possible. Sometimes downsizing is rational. Sometimes keeping a low-rate mortgage and maintaining investments is better. Sometimes paying it off improves the plan. The decision must be modeled. Do not rely on slogans. Now, let us talk about the psychological divide. The invest first person often sees mortgage payoff as irrational. They say, the market returns more. Why would you lock money into a lower return than debt? Free person often sees investing first as reckless. They say, the market could crash. Why keep debt when you can own the house outright? Both sides are seeing part of the truth. The invest first person understands opportunity cost. The debt-free person understands risk and obligation. The best answer respects both. A mortgage is not bad simply because it is debt. Debt can be useful when the rate is low, the term is fixed, and the borrower is disciplined, but debt is not harmless simply because the rate is lower than expected market returns. Debt creates fixed obligations. Fixed obligations reduce flexibility. The question is whether the debt improves or weakens the total system. This is why I do not like absolute rules. Always pay off the mortgage early. Never pay off the mortgage early. Both are too rigid. Principles are better. Low rates, long time horizon, strong liquidity, high risk tolerance, tax-advantaged investing available. Lean toward investing high rates, shorter time horizon, weak liquidity. Retirement near fixed expenses, tight, high anxiety about debt. Lean toward paying down middle range, use hybrid. That is the framework. Now, what does the data say in practical terms below? About 4% keeping the mortgage and investing tends to be favored, especially if the investor has a long time horizon and actually invests the difference above about 6%. Paying down the mortgage becomes more compelling, especially once taxes, volatility, and retirement risk are considered. Between 4 and 6%, the answer depends on the household. That is the gray zone. The gray zone is where personal planning matters more than generalized advice. You need to ask what the money would actually do if not used for the mortgage. Will it be invested? Will it sit in cash? Will it be spent? Will it go into a Roth IRA? Will it go into a taxable account? Will it increase emergency reserves? Will it reduce credit card debt? The alternative matters. If the alternative is paying off 20% credit card debt, do that before worrying about a 4% mortgage. If the alternative is getting an employer match, capture the match before sending every extra dollar to a low-rate mortgage. If the alternative is building an emergency fund, build liquidity first. The mortgage decision comes after the foundation, emergency reserves, no toxic debt, employer match, adequate insurance, reasonable retirement saving, then optimize mortgage versus investing. If the foundation is weak, optimization is premature. A person with no emergency fund should not be aggressively prepaying a mortgage while staying fragile. A person with high-interest consumer debt should not focus on low-rate mortgage payoff before eliminating the high-rate debt. Order matters. Now, let us build a decision tree in plain language. If your mortgage rate is under 4%, your income is stable, your emergency fund is solid, and your time horizon is long, keep the mortgage and invest extra money. If your mortgage rate is over 6%, retirement is near, or the payment creates stress, strongly consider paying it down faster. If your mortgage rate is between 4 and 6%, split extra cash between investing and mortgage principal based on age, liquidity, tax bracket, and peace of mind. If you are young with decades to compound, lean more toward investing. If you are mid-career and retirement is visible, move more toward balance. If you are near retirement, lean more toward reducing fixed expenses if debt keeps you awake at night. Peace of mind has value. If lack of liquidity keeps you awake, do not overpay the mortgage too aggressively. This is a practical way to think. Now, the important thing is not to confuse homeownership with complete safety, even a paid off home has expenses, property taxes, insurance, maintenance, repairs, utilities, HOA dues. If applicable, a paid-off mortgage removes principal and interest. It does not remove all housing costs. That matters in retirement planning. Paying off the mortgage can dramatically reduce fixed expenses, but it does not make the home free. You still need cash flow. You still need reserves. The roof still ages. Insurance premiums still rise. Property taxes may increase. A debt-free home is powerful, but it is not a substitute for a complete financial plan. Now, what about investing the difference? Investing only works if the money is invested consistently and left alone long enough. If you invest extra dollars but panic sell during downturns, the expected return may not materialize. If you chase speculative assets, the comparison to broad market historical returns no longer applies. If you pay high fees, the after-fee return shrinks. If you constantly change strategies, compounding is interrupted. So when we say investing may beat mortgage payoff, we mean disciplined long-term investing, not random trading, low-cost diversified investments, tax-advantaged accounts where possible, long-time horizon. Behavioral discipline, that is the comparison, not mortgage payoff versus gambling. Mortgage payoff may beat reckless investing easily. This is another reason people argue about this topic. They are often imagining different investment behavior. The disciplined investor says, I will put the money into a broad index fund for 30 years. The undisciplined investor says the same thing but spends it or trades it. The outcome will be different. Behavior is part of the return. Now let us talk about regret. If you pay off the mortgage early and the market rises dramatically, you may regret not investing more. If you invest instead and the market crashes, you may regret not paying down the mortgage. The hybrid strategy reduces regret. It gives you progress in both directions. It is not the mathematically pure answer after the fact, but before the fact, it may be a more robust answer. Because the future is uncertain, many people underestimate the value of regret reduction. A strategy you can stay with is often better than a strategy that is theoretically optimal but emotionally fragile. The goal is not to win the spreadsheet contest. The goal is to build a life that survives reality. Now, one more point about mortgage rates. People with low fixed rates from earlier years have a valuable liability. That sounds strange, but it is true. A liability can be valuable if the rate is far below current rates and inflation reduces its real burden. If someone has a 3% 30-year fixed mortgage while cash can earn meaningful yields or investments can compound long-term, that mortgage is a favorable financing arrangement. Paying it off early may feel good, but it may reduce flexibility and expected wealth. However, if the person is deeply uncomfortable with debt, the emotional benefit may still justify extra payoff. Again, numbers and psychology both matter. People with high-rate mortgages face the opposite problem. At 6 or 7%, the mortgage is not cheap. The guaranteed return from paying it down is real. If refinancing becomes available in the future, the decision may change. But until then, the debt is compounding against the household at a meaningful rate. Paying some of it down can be rational. Now, the decision may also change over time. At age 35, invest more. At age 45, split more evenly. At age 55, pay down more aggressively. At age 65, perhaps eliminate the mortgage if liquidity permits. A plan can evolve. You do not have to choose one permanent identity. I am an investor, I am debt. Free. Better to say, I am trying to optimize the system for my current phase of life. That is how mature planning works. The system changes, so the allocation of extra dollars can change. Now let us examine the emotional value of control. A paid-off house gives control. If the mortgage is gone, no lender can demand that monthly payment that can feel like freedom for retirees. This can be especially powerful. A paid-off home lowers the income required to survive. It reduces the risk that a market crash forces withdrawals to meet housing debt. It can give the person confidence to hold investments through downturns because the roof is not tied to a portfolio withdrawal in the same way. That emotional stability can improve investment behavior. A person with lower fixed expenses may be less likely to panic sell. That is a hidden return. Peace of mind can produce better behavior. Better behavior can produce better outcomes. This is why not everything fits neatly into the spreadsheet. Now let us also examine the value of flexibility. Keeping the mortgage and investing can create liquid wealth. A taxable brokerage account can be accessed if needed. A retirement account has restrictions but still builds future security. Cash reserves create immediate flexibility. Home equity is less liquid. If you put every extra dollar into the mortgage, you may have more equity but less flexibility. For a young family with children, unstable income, or large future expenses, flexibility may be more important than rushing to pay off the house. This is the other hidden return optionality. A dollar in an investment account may be easier to rebalance, withdraw, or redirect than a dollar of home equity. A dollar in home equity reduces debt, but may be hard to access. Neither is always better. Each has a role. Now, what is the best answer? The best answer is the one that aligns with rate, time, tax, risk, liquidity, and temperament. A person with a 3% mortgage, 30 years until retirement, strong savings, and discipline should probably invest more. A person with a 7% mortgage, 10 years until retirement, limited cash flow, and stress about debt should probably pay down more. A person with a 5% mortgage and mixed priorities should probably use a hybrid strategy. This is not weak advice. It is systems-based advice. When variables differ, answers differ. Now, let us close by returning to the core principle. If you pay off the mortgage, you are buying certainty. If you invest, you are buying possibility. Certainty has value. Possibility has value. The right balance depends on where you are in the arc of life. Early in life, possibility often deserves more weight because time is on your side. Later in life, certainty often deserves more weight because recovery time is shorter. In the middle, balance often works. Do not let someone else's emotional preference become your plan. The debt-free person may not understand the value of compounding. The invest at all cost person may not understand the value of control. You need to understand both. Then decide. Use the data, use the framework, but do not ignore your own life, because the purpose of money is not to win a theoretical argument. The purpose is to build a system that lets you live securely, confidently, and with control. Sometimes that means keeping the mortgage. Sometimes that means paying it off. Often it means doing both in the right proportion, at the right time.